After a slump in oil and gas prices created by the COVID-19 pandemic, it started in the spring of 2020, we're now seeing much higher prices, and some people are predicting that prices are going to go much higher in the future. For an explanation of why, I'm going to talk to economist Richard Masson from the School of Public Policy at the University of Calgary. So welcome to the interview, Richard.
Good to be here, Martin.
So why are oil and gas prices so high?
Well, it's a combination of factors, like it always is when things change. One big piece is, the low prices that you talked about led to companies really cutting back on investment. And it had already been a trend where there was underinvestment in the oil sector in particular over the previous couple of years because prices were unstable and a little weak. And so COVID made it worse. And on top of that, we've now started to come out of COVID. And so demand has really rebounded globally. And it's putting a lot of pressure on the whole system to try and meet that rebounding demand. Europe, natural gas demand is way up and there's not enough inventories. China, as manufacturing increases, demand is up. There's not enough coal. They're moving to natural gas. So everybody's fighting for natural gas. And of course, as you jack up natural gas prices, that leads people to switch where they can to oil instead. So it's a lot of things going on.
Now, we've been reading about the gas shortage and coal shortage, I guess, as well in Europe, and the problems that Vladimir Putin in Russia is causing Europeans by playing games with gas supply. Does that have any impact on Canadian prices?
It's a very indirect link to Canadian prices. So North America has a limited amount of ability to ship natural gas around the world. So the US has a few LNG plants that are operational. So as prices has really jacked up in Europe, 2.5 times or 3 times what they were this summer, that's meaning that anybody who can export LNG is doing that. So the US is exporting as much as they can. That's pulling prices up in North America. So we've seen NYMEX over $6, and some peaky things. And that indirectly helps Alberta prices, but it's very indirect because we have a limited amount of export capacity in North America, none in Canada at this point.
What about prices in Western Canada? Is the economic rebound strong enough here to boost the price of natural gas?
Natural gas is part of a big North American market. So if Canada is kind of 15 billion cubic feet a day, the US produces and consumes 80 plus billion cubic feet a day, and we're very interconnected. And so whatever happens in the US leads to natural gas prices in Alberta and Western Canada. And those prices get set every hour of every day because we have such interconnectivity with pipelines. So it's really what's going on in the US, the strong rebound that we're seeing there, more and more petrochemical plants being put in place in the Gulf Coast, and now some LNG plants. Those are the things that are really changing the supply-demand balance and leading to higher prices in North America.
What about on the oil side? We're seeing prices up around $80, $82 for Brent, WTI high 70s, and Western Canadian Select high 60s. Do you expect those to stay roughly where they are, or are we going to see even higher prices over the coming months?
Well, I think that most folks that I'm watching are concerned that prices are going to continue to go higher. So because natural gas prices have gone up so much in Europe, and there's such a scramble to find supplies to keep homes heated and factories running over the course of this winter, and because coal, has to pay a big penalty because of the price on carbon that they have in Europe, so that makes natural gas more attractive than coal. All that's leading to what's called fuel switching, where power plants that can move from natural gas to oil as a source of fuel are doing that. So I've seen estimates where 650,000 barrels a day of new demand could come just because natural gas prices are so high, on top of the already rebounding demand for gasoline, diesel, and jet fuel as people are starting to get into planes again. So all of that is leading to what people expect to be very strong prices over the coming few months, in part because there's just not a way to meet that because we haven't been investing in new drilling activity much over the last couple of years.
Now, what will that likely do to consumer prices? Are consumers in Western Canada, for instance, going to see big heating bills this winter? Are they going to be paying a lot to fill up their vehicles?
You know, all of that will filter back. I think we're already close to record natural or gasoline prices. That's a very liquid and traded market. So the price in the US flows back to Canada. And if Canadian prices were too low, it would incent refiners to ship their gasoline into the US to make more money. So we'll see the same type of price increases that the US does. In terms of natural gas, we're going to be better off because we're further away from the market and we have a fairly decent supply here. So as I said, you know, Europe's prices have more than doubled. In Canada, our prices are up kind of $4.50 where they used to be $2 to $3. So it's going to lead to an increase, but it's not going to be the type of spike that we've seen in Europe and some other places that are really scrambling for supplies.
Now, every time that the gasoline prices go up, and there's always cries of collusion and price setting, and there have been any number of studies, any number of even royal commissions on this issue, and they all come back and say, no, it's just the market fundamentals. Would you like to take just a minute to debunk it once again?
Well, the way I look at this is there's so many refineries in place, right? So we want low prices. And in order to deliver the lowest prices, refineries have to run almost always at full capacity, which is like 95% on-stream factor. They have a little bit of maintenance. So to be an efficient operator, every company tries to get the most out of their billion-dollar refining asset. That means that when there are shortages, when demand is stronger than supply, there's not a lot of excess capacity to increase the amount of gasoline available. And so you end up with higher prices because higher prices lead to some people driving less or flying less. That's how we ration the available supply. So it's all about, you know, as consumers, we want low prices all the time. The industry is designed to give us that, but it means that when we get short, prices can spike a lot because it doesn't take a big change in demand to really push up prices and incent people to get out of the system.
Well, Richard, thank you very much for this. Always appreciate your insights.
Yeah, it's always great to be here, Markham. Take care.